In trading, managing or moving the stop loss serves two fundamental and very important purposes. These are protecting your capital and securing or locking in profits when and where necessary. Regardless of how good a trader is at forecasting the direction of the markets, and no matter how effective the trading tools and indicators are or claim to be, the fact of the matter is that sloppy stop loss management will inevitably produce sloppy results in terms of long-term profitability and consistency. It really is as simple as that. Effective and efficient stop loss management is supremely important if you want to consistently extract money from the markets and also protect your capital. Some would even say, and quite rightly so, that the management of a trade via the stop loss accounts for more than half of the overall story of trading. This may even be a conservative estimate. Needless to say, this is quite an important video, and for some will perhaps highlight the missing link in your trading routine. Now, ideally, the process of moving the stop loss must be systemized and carried out in a way which is methodical and almost robotic. Anything less than this will leave you at the mercy of fluctuating emotions and will most likely lead to expensive mistakes. Some of you may have experienced this already. Okay, so let's dive right in and take a look at 5 different options related to stop loss management when using the wealth crossover indicator from FoxEx. Option 1 is the percentage stop loss. When using this method, we have a specific rule in our trade management methodology, which, for example, would go something like this. Trail by increments of 1%. When price reaches a profit of 1%, move the stop loss to break even. When price reaches 2% of profits, move the stop to 1% and lock in some profits, and so on and so forth. The positives of this method are that it is very easy to follow and very easy to understand, and also it is mechanical and robotic and removes the possibility of quote-unquote emotional trading. The negatives of this system are that you must be at your charts at the appropriate time, and this may not be convenient, especially when trading the lower time frames. Also, moving the stop in this way may suffocate the trade and cause the trader to get stopped out during a pullback in the market. Option number 2 is the break-even stop. The break-even stop is all about protecting capital and reducing the amount of time spent looking at the charts and the computer screens. With this method, we simply move the stop to break even when price reaches a predetermined level, for example 1% of profit or 100 pips or whatever amount or percentage you choose. With this method, once the stop is moved, we can relax in the knowledge that our capital is now protected, and we then simply leave the trade to either hit the target for a profit or come back and hit the stop loss for a break-even trade. Either way, with this method, no capital is lost except on trades where the break-even point isn't reached. The positives of this method are that 1, it is very easy to understand and implement, and 2, it doesn't require the trader to sit at the charts for excessive amounts of time. Number 3 is that it eliminates the compulsion to quote-unquote babysit or tinker with open trades. Fourthly, it offers the trade plenty of room to breathe between the entry and the take profit levels. And lastly, once again, it is mechanical and robotic. The negatives of this method are that 1, you must be at the charts when price reaches the break-even point. Secondly, it should be used in conjunction with a very efficient and effective targeting method. And lastly, it will sometimes cause you to miss opportunities as price moves into a large profit without hitting the target, only to come back and hit your stop loss. Option number 3 is called the 3-bar rule. The 3-bar rule is a stop loss management system, which means that we move the stop according to the high or the low of the last 3 bars. For example, in an uptrend on the daily time frame, we move the stop loss to the lowest low of the last 3 bars or the last 3 days, with of course the first move being on day 4. On day 5 we move the stop to the low of day 2, and on day 6 we move the stop to the low of day 3, and so on and so forth. In a downtrend everything is the same except that we use the highs of the candles instead of the lows. When using this method, the positives are that for those who trade the higher time frames, it requires very little screen time as the stop will be moved once per day, and this process only takes a few seconds. Secondly, depending on the way in which the bars form, this method can be a great way of locking in profits incrementally. And thirdly, and it's worth mentioning this each time, the process once again is mechanical and therefore removes the compulsion to tinker with trades based on fluctuating emotions. The negatives of this method are, for those who trade the lower time frames, it will require a lot of screen time as the stop loss will be moved according to new bar formation on the charts. Furthermore, depending on the way in which price unfolds, this method can potentially suffocate the trade and thus cause the stop to get hit prematurely even on a good or a successful trade. Lastly, this method doesn't account for the natural cyclicity of the markets and the inevitable pullbacks in price which occur on all symbols and all time frames. Option number 4 is called the swing stop. A swing stop is based on the cyclicity of the markets. As you are all well aware, the markets do not move in straight lines but instead move in cycles both in the upwards and the downwards direction. With this method we move the stop according to the swings or the cyclicity of the markets. We can also move the stop according to the swings of the lower time frames, which of course cycle more frequently and provide us with more opportunities to lock in profits. For example, when trading the daily time frame, we may choose to move the stop loss according to the cyclicity of the H4 charts or the H1 charts. The positives of this method are that not too much screen time is required, especially when moving the stop via the higher time frames. Secondly, this method typically offers the trade plenty of room to breathe. And thirdly, it locks in profits consistently even if the targets are not reached. And lastly, once again, it is mechanical and robotic. The negatives of this method are that it can be difficult to implement and will require a healthy understanding of cyclicity and the swing structure of the markets. Thirdly, it requires the trader to be at the chart at the appropriate time. And fourthly, we never know in advance when a news cycle will form on the charts. Option number 5 is the wealth crossover Bespoke Method. This method is an open invitation to you to create a method of stop loss management according to the lines of the wealth crossover indicator and the wave structure of the market. Here is an example of a wealth crossover Bespoke Method. Step 1. Break even when price reaches the midpoint of the wave or the initial crossover of the blue and purple lines. Step 2. Once the stop is at break even, allow the trade to either hit the stop loss or hit the take profit. Alternatively, step 2 could be something like this. Once the stop is at break even, trail by a percentage or an amount of pips, for example 2% or 200 pips. With the wealth crossover Bespoke Method of stop loss management, there are countless ways that we can systemize the management of the stop based on the wave structure of the markets and the lines of the wealth crossover. As always, the important thing is to choose an effective system and implement it consistently and avoid moving the stop loss just because you feel like it. The positives of this method are that it offers you much more freedom to create your own system of stop loss and therefore trade management. Number 2 is that it leverages the power and the consistency of the wealth crossover indicator and the wave structure of the markets. Thirdly, it eliminates the rigidity of the other stop loss management options mentioned in this video. And fourthly, it can be customized based on certain symbols and on certain time frames. The negatives of this method are that 1, it will require discipline and most likely quite a bit of experience. 2, it requires a thorough understanding of the wealth crossover indicator and how it works. Thirdly, you must be at the charts when price reaches your desired targets. And fourthly, it must be used in conjunction with very efficient and effective targeting methods. This has been a short video on methods of stop loss management when using the wealth crossover indicator from FoxEx.